session. Okay, we are on record. The reason why I was asking whether it is okay for you to ask questions live rather than writing is for two reasons. Because as I told you, especially today, I want to have a very interactive session because we're going to make exercise on the mechanics of the right issue. And I want to have live questions so we can have interactive discussion, and the session would be as good as we can get to a very live session that, you know, before pandemic, you know, time, you know, it was the norm, okay? And the second reason also because to see the presentation, talk, and see the question, sometimes, you know, I lose balance. And so it would be helpful for me. But you can do both. I try to manage, but it's only, again, as I told you, to have a more interactive and a more, you know, open and live discussions. Today, we will go through some technicalities, or most of the technicalities of the right issue and the private placement, in order to check whether all the key concepts of the capital increase of the right issue are totally absorbed and digested by you students. And we will do a couple of exercises together. I will do it for you, but I want you to follow me and look at the numbers and asking questions, okay? So what we'll do is to try to imagine to be together here for the capital increase. We got on Thursday night the nulla osta. Thursday night, why? Because the concept, the watchdog institutions, that is the regulator for the markets, usually meet on Thursday and Tuesday. And on Thursday night, usually they provide the final guidance for any transaction. And so basically, you need to assume that on Thursday night of a year, we got the green light from the regulator. So basically, the morning after, we go to the client, and we explained that we got the green light, and basically we summon the board of directors during the weekend because we need to set up final terms of the transaction. You remember here, at the time of the announcement, we have announced, as a board, we have announced a underwriting in volume. So we said that we're going to raise $1 billion, and Morgan Stanley and JP Morgan will, or Goldman Sachs will be global coordinator, and they will underwrite this transaction in volume. When you go down the road on that weekend that we need to fix the terms, we, as a bank, this time around the underwriters, will underwrite the famous billion, not in volume any longer, okay? But they will underwrite the capital increase. How? By underwriting a number of shares, the shares that will be issued at a price, which is the subscription price. And on Monday morning, first thing in the morning, will happen the famous technicality that I explained to you, where the shares that has been trading for months as a normal share, cum all the rights, will start trading X rights. In other words, theoretically, the shares will start be trading on that Monday on a TERP, like a theoretical X rights price. And since then, they will be trading in the marketplace like a naked share, because the rights to subscribe the new shares are theoretically detached. It's like you take two pieces of paper and you strip them off from the shares, and with this piece of paper you go to the shareholders meeting, and ideally you are demonstrating that you are entitled to subscribe the new shares and you want to exercise the rights. So there will be two securities in the marketplace. So what was trading in the marketplace on Friday as one share only with all the rights, on Monday, after you set up the final terms, two security butterfly up in the marketplace. One is the naked shares and the other one is the rights. Okay? Now, these two security environment that they will be trading in the marketplace will last for 3 weeks. Okay? There are 2 weeks of trading of the rights and 1 week of subscription for those rights, to exercise the rights and the subscription period. Let's see what happened in the market. Let's see the mechanics. If you remember, what I told you was that the right issue, the way is organized and masterminded here, typically in continental Europe, but also in UK, has been masterminded to protect the interests of the existing shareholders. In other words, you need to think about it that, you know, the whole continent is made mostly of companies that they used to be owned by families or by single shareholders. I think about Fiat at the time, Agnelli family, Peugeot family, Renault family, and so on and so forth. Ferrari, Prada, Ferragamo, is plenty of companies still family owned. So the capital increase was masterminded to create an exercise whereby if there is a capital increase, the economic interests of those families will be protected. Of course, will be protected the interests of all shareholders, okay? What I'm trying to tell you is that I want to demonstrate here that when there is a capital increase, the capital increase is not dilutive from an economic standpoint. So when I will be asking you during the, at the exam or in any discussion, or when you will go to a committee, at Goldman, at JP Morgan, and Morgan Stanley, please remember that the capital increase is not dilutive from an economic standpoint. There will be dilution, but in different fashion and shape, okay? Let's see what happened in the market. Let's be laser focused on this column. Basically, you need to think about it that when you got the nulla osta on Thursday night, as I mentioned to you in the timetable, and on Friday you call the shareholders, the board of directors, the price of the shares on Friday afternoon will be closing at €1. This share is a share cum rights. So to make the example, that is not the case any longer because everything is done electronically, but think about the old times, all these shares are trading in the marketplace with all the rights attached, okay? With all the bits and pieces of the paper attached to the shares. So it's trading at €1 with all the rights. And basically, we have agreed at the board that for every 2 shares that are in the market, there will be 1 new shares issued. So the ratio will be 1 new shares issued for each 2 shares available in the marketplace. And we gonna issue these shares at a price that is 40 cents per euro. So now we have set up the terms, okay? Basically, we got the price cum, we got the ratio, and we got the price of the new shares. And let me tell you, the TERP is 80 cents. Let me tell you how we calculated this TERP, okay? Let's assume that in the market, the outstanding shares are 500 in case this is the column, assuming that the existing shareholders will subscribe all the shares, okay? And because we will be issuing one new shares for every 2 shares in the market, new 250 shares will be issued in the marketplace. And let's do the math now. If the TERP is equal price of the shares cum, €1, times number of shares outstanding, 500, plus the price of the new shares, the subscription price, 40 cents, times 250, the number of shares that will be newly issued, divided 750, the total number of shares. If you do the math, you got 700 divided by 750 equal the famous 80 cents here. Okay? So if someone will be asking you on Sunday, okay, Massimo, Luigi, Antonio, Michela, whoever is the name, what do you think will be the theoretical price where the shares, once they detach the right, will be starting at trading on Monday morning first thing? Theoretically, the price, the answer is 80 cents. Then, of course, once for 1 second the market opens at 80 cents, then there will be demand and supply of the shares in the marketplace because the shares are traded, are liquid in the market, and the price can go up or down based on the economic news, based on the flow, based on the state of the market, whatever. But theoretically, the price, once it's detached the rights, will be start trading at TERP. Okay? Why we think that is economic neutral? Let's do the exercise together. And again, let's be focused on this case. So there are 500 shares in the marketplace, okay? And the shares are valued €1 before the transaction. So the value of the stake of the company is 500. We will be issued 250 new shares, and to buy these and to subscribe these new shares at 40 cents, you will be spending 100, which is 40 cents times 250. So basically, theoretically, your position will be, I have 750 shares, that market will be valued at 80 cents. So my position, because I have all these shares, will be valued 600. Okay? And let's see whether it's economic neutral. I got the final position of 600 in shares, but as you know, we spend here 100 in cash. So I have more shares minus the cash that I spent. And here we go. I come back to my economic position that was exactly the same that I used to have in the first place. Okay? So if I subscribe all the shares, I start from 500 and I end up in 500 in economic position. Can you reassure me that so far so good? You are with me?
Professor,
Yeah.
could you please repeat the last passage in which we exchange cash, please?
Okay.
Thanks.
So let's start again. We have 500 shares. The starting position, you personally, you have 500 shares. And those shares are worth €1 each. We are on Friday, okay? During the weekend, we set up terms and we say, okay, dear friend, you got 500 shares, so you have the rights to subscribe 250 because that's the ratio. I will issue 1 shares for each 2 that you have. So de facto, 50% of your shares, 1 divided by 2. And here we go, the shares that you issue. And I give you the possibility to subscribe those new shares at 40 cents. Okay? We also said on Monday, your position physically will be the sum of 2 things. You're going to have the shares naked, X right, and you got the rights. For each shares, you have 1 rights, and you need 2 rights to subscribe a new shares. And the shares will be trading on Monday morning at 80, the famous TERP. Let's do what happened. You got 500 shares, you subscribe 250 shares because you decided to exercise all the 500 rights to subscribe 250 shares at a ratio 1 to 2. How much money you spend to subscribe those new shares? You got 100 in cash to be spent, okay? Because you need to subscribe 250 shares at 40 cents. So 40 cents times 250 equal 100 of cash out. Once you have done it at the end of the process, what you got 750 shares because you subscribed 500 here. No, you used to have a 500 here and you subscribed 250 here. So you have 750 shares that are theoretically worth 80 cents per share. So the value of those shares will be 600. But because you spend here 100 in cash to subscribe these shares, your balance sheet theoretically is, I got more share, 750, value at 80 cents, so my value of the stake is 600, but in order to be in that position, I spend 100, that is, let's call it either less cash or more debt. So basically 600 minus, so these 600 in shares minus the subscription payment, which is 100, equal 500. Is that clear now?
Absolutely, thank you.
Okay. Let's go now in the other situation, case number 2. While your friend was very positive on the transaction and he has money or he has credit line to do the transaction, he ended up to subscribe all the shares. To subscribe all the shares, basically, he got in the position to have 750 shares. But let's do the calculation, assuming that on the contrary, you don't want to subscribe the shares, and what you do, you sell your own rights in the marketplace. Because you said, I approve this capital increase because I believe that it is good for the company. We need to raise capital because we need to restore the solvency ratio, or we need to restore the capital structure. It is good for the company, but for a number of reasons, I don't want to put additional amount of money at work for this company, or maybe I don't have this money, or I don't want to use credit lines for that. So I decide to sell the rights. Okay, let's do that again. My position starting point is 500 shares. Okay. And basically, what I decided to do, I sell all my rights. I have 500 rights. You remember I told you, you need to think about this share with a little piece of paper attached to it that you need to strip it off, go to the cassa incaricate, to the banks, and say, I'm a shareholder and I want to exercise this right. Or alternatively, you strip it off, you go, you walk and go to the bank and say, this is my rights. I want to sell it because I don't want to subscribe the shares and I want to sell in order to be restored economically. So you get the 500 rights. Those rights are worth 20 cents. Okay? And I tell you now in a second why. And basically, you cash in 100 because you sell all the rights in the marketplace, 20 cents times 500, and you cash in 100. Let's see whether your economic neutrality is fully respected. I got 500 shares because that was the starting point here. Okay? These 500 shares are worth 80 cents each because theoretically in the first second they will be worth at parity the theoretical ex-right price. So 500 shares at 80 cents, my position in shares are 400. But because I sold at 100 all my rights here, 400 in shares plus 100 in cash equal 500. So whether I subscribe all the rights here or I sell all the rights here, the economic final position from a theoretical standpoint is actually the same. Let's see, to anticipate the question. Okay, Professor, why we value the rights at 20 cents? Let's go back to the definition. The value of the rights is de facto an option. You remember? How do you want to call an option to subscribe new shares at the subscription price? Technically, this option, how do you call it? The right to subscribe the shares at 40. The possibility to subscribe to buy an asset at the one price, how do you call it in finance, this option? It's a very simple question. Yeah, but how do you call it, this option premium? Call option, bravo Marco. So the right value is like a call. The value of the call is given by the fact that I can buy shares in the marketplace at TERP, because that's the theoretical price that should take place in the market. We said 80 cents. And this 80 cents minus the strike price, which is 40 cents, the subscription price, equal 40 cents, the difference, times the ratio, 1 divided by 2 in our case. So if you do 40 cents, 80 is minus 40 times 50%, 1 divided by 2, you got to the famous 20 cents here. Okay? Let's go back. So is it clear now? 1 second. Is it clear now, in this case here, the middle case, the way I calculated the economic neutrality, how we end up in this 500 and 500 position, equal to the full subscription case? Do you want me to repeat it again, or is that clear? Very clear. Okay, excellent, excellent. Or let's do the third case. You could be in a, how can I say, in the middle position, what we call the operation Blanche. It is a very technical position in the trading where the shareholder has approved the transaction, but for some reason wants to be cash neutral and wants to sell a number of rights in the marketplace to raise cash enough to subscribe a number of shares that doesn't change the cash position. Operation Blanche or cash neutrality, it is the middle point between full subscription, where you have a cash out of 100 here, because you subscribe the shares here, and selling all the rights, where you cash in the full value of the rights. To stay in the middle, where the cash position is neutral, is called Operation Blanche. And you do exactly the same thing. The only difference is that rather than selling all the rights, 500, you sell half of the right, because the ratio is 1 divided by 2, 250. And you subscribe with the remaining rights, 250, you subscribed here 125 shares. As a result, you got only 500 shares because you have the 500 shares in the first place, plus the 125 that you subscribe here, 625, that at 80 cents per dollar, 80, you got the value of 500 in value. But because you have a position cash neutral, because you sold the rights to raise cash to subscribe the new shares, you end up in a position of 500. So the three positions are actually the same. Again, one is more share, less cash. The other one, the lowest number of shares as possible with more cash. And the third one here is cash neutral with the number of shares that you subscribed, fully financed by the sale of the rights. So if I ask you, is that clear that the capital increase and the right issue is economic neutral for all the shareholders? The answer is yes. And please confirm that you are with me. You got the three cases, and I demonstrated the way it works, the mechanics. Okay. Okay, it is clear. Thank you very much, Andrea. Now let's see where the dilution is, though. It is true that the capital increase could be dilutive, but not economically. Okay? Where, in your opinion, is dilutive? Let's see whether we work on the same place. We are on the same page. What is dilutive here? Okay, Lorenzo, please.
Yeah, can you hear me?
Yeah, perfectly well.
Okay, I think in terms of ownership, depending on how much shares you subscribe, the ownership percentage that you own changes.
Perfect. Excellent. Excellent. If you can see here, in the three position, the final ownership is changing dramatically. The only position that is not only economic neutral, but also governance ownership neutral is this one. Because you got a number of shares in the first place, and you subscribe all the shares, and de facto you are not diluted, neither economically nor in terms of ownership. But if you don't have the money, or you don't want to spend the money, and you sell all the rights, you can see the dilution, because from 10% you go down to 6.7. in our example. And if you are in the middle, the dilution from 10 goes down to 8.3, but still there is a dilution in terms of rights. So let's introduce the discussion on why there is a big negotiation when you got the nulla osta from Consob on Thursday night. You go with the client to the watchdog institution, to Consob, you receive the green light, you meet on Friday with the client, and then you agree to call a board to define terms and conditions of transaction. And in your opinion, there could be a big negotiation here or not. So let's look together the dynamic of the right issue. As I told you in the timetable, okay, when we are here, 1 second, when we are here, banks, once they set up terms and conditions with the board and with the CEO and the team about the capital increase, are not on the hook any longer in volume, but as I said, we are on the hook because we issue, for in our example, 250 shares at 40 cents. So now the guarantee is very specific. And we have been on the hook as an underwriter up to here in volume, 250. Actually, you need to raise the famous 100, okay? We don't know how many shares, at which price. But from now on, after this level, for 3 weeks, our guarantee will change dynamics, and we'll be on the hook for 250 shares, the newly shares, at 40 cents. So, in your opinion, which are the dynamics here? Number one, how do you define a guarantee where the board is asking banks, the underwriter, to subscribe shares in case here, at the end of the process, in case here, we have a ramp. So in other words, if neither the existing shareholders or the market, the rest of the market, will end up subscribing the shares, there will be a ramp, and this ramp will be end up on the lap of the underwriters, and the underwriters will belong at 40 cents per shares up to 250 shares. So in your opinion, if the banks will belong to shares during the process because they sign a guarantee, which is called the underwriting commitment, what is the dynamic between the board and the underwriters, in your opinion? Do you think that the economic interests are aligned, or do you think that they could have some discussion? There will be some position where they are on different places and they need to negotiate. Okay, Andrea.
Maybe, can you hear me?
Yeah, very well indeed.
Maybe the bank will try to put up a subscription price as low as possible.
Okay. And what could be the interest of the board?
Their additional shares.
Sorry?
Sorry, sorry, my connection got a little slow.
No.
You were saying?
I was saying, okay, underwriters, in your opinion, have interest in having a very low, as low as possible subscription price. Fine. I ask you guys, what do you think is, on the contrary, the interest of the board? The board represents the interest of the shareholders, no? Please go ahead. Lorenzo, what do you think?
I think, Professor, it's you want to issue less shares possible, and so having a subscription price that is high.
Exactly. So, de facto, you can tell that on the famous Bloody Friday evening, the important conflict between board and underwriter immediately, suddenly materializes, because we need to say the famous billion, or 100 in our case, needs to be raised at one price, subscription price, with a number of shares. And the board, and I show you the dynamics, wants to have a very high subscription price, because to raise 100 with a high subscription price, you issue less shares, and de facto, you pay the way for a further protection to the existing shareholders, because in case the existing shareholders don't have the money, we have seen that it will be restored economically, but by not subscribing the shares, the little number of shares that you have to issue, the lower will be the dilution in terms of ownership structure. Think about if there is a family that owns Ferragamo, Prada, Fiat, Pirelli, you name it, anything, that they own the company. If for some reason, they don't have all the money to subscribe the shares, in other words, to be in the first column, either they do the Operation Blanche or they sell all the rights. We have seen that mechanically they get economically protected, but they get diluted as well. So the lower is the number of shares that will be issued as a result of a higher price in terms of subscription, the lower will be the dilution in terms of ownership structure. On the contrary, we said, so the position of the board vis-a-vis the shareholders is actually very clear. But why, in your opinion, banks, the underwriter, wants to have, these subscriptions price as low as possible? Let me ask you, what is the underwriting agreement de facto? If the board has the possibility to force underwriter to subscribe at 40 cents all the shares, 250, that will be issued, in case neither existing shareholders nor the rest of the market will subscribe them. How do you call this structure? What is the board will have in his hands by agreeing and negotiating an underwriting agreement? How do you call this power, this right? Let me help you while you're thinking. While the shareholders have a right, the famous bits and pieces of paper that they detached to have the new shares. In other words, they have 500 shares and they have 500 rights that we call, for simplicity, de facto a call. The call, the possibility, the option to subscribe new shares at 40 cents. But now the board, in terms of option, which kind of option they have in their hands? Once they negotiate and agree, is a put option, okay? Everything looks simple, but you need to go step by step in the process. So when you have a put on underwriters at 40 cents, what is the interest of the banks? To have the obligation associated with the put to be as remote as possible from the market, okay? And basically that's why I said in the first place, an important things. We know that what is theoretically the market? Theoretically, the market is the famous TERP, okay? This is the TERP, the famous 80 cents. This is the TERP. And the interest of the banks is to have the subscription price, which is the strike price of the put. Strike price of the put, which means where the option kicks in and their obligation become live, they have it at 40 cents. This is the sub price. And in the famous exercise that we have done together, we have seen it that the interest of the board is to have this subscription price, the 40 cents, as close as possible to the TERP. Because if you have a put at market level, de facto the value of the put is immense because you have totally neutralized the market risk. If I have a put on you guys at market level, at TERP, great. So I'm fully protected from the market risk. On the contrary, the underwriter wants to have this 40 as low as possible because, as you said, there has to be as far as possible from the market in order to reduce the economic risk that this obligation will materialize. Okay? So the underwriter wants to have the 40 as far as possible from the 80, the subscription price, while the board, in the interest of the shareholders, wants to have this subscription price as close as possible to the market. Big fight, big negotiation. Usually when everything is fine, this negotiation could be relatively simple because, it's in the common interest de facto to have a nice, smooth discussion and go into the marketplace. But sometimes, if there are specific situations at shareholders level, or you have board member pretty stubborn, and sometimes not financially educated, this discussion could be very harsh and ugly. Being very harsh and ugly means that it could be for the whole weekend, because once you got the green light from the regulator, on Monday you need to launch the transaction and the board has to approve it, otherwise they are in trouble. So this negotiation will end up, and basically on which ground do you negotiate those things, okay? The number of shares to be issued at which price. De facto, the difference between the subscription price and the TERP here, between subscription price and the TERP, the difference between 40 and 80 is called discount to TERP. And let me go back. Let me go back when, here we go. You see, those are recent financial institution precedents, and you can see where the market stands. When the board negotiates with the underwriter, de facto negotiate the discount to TERP, which is the distance between the theoretical exercise price versus the subscription price. And you can see the usual range is 26 to 27%. And so basically, when you go into the market, if you announce something that is outrageously out of proportion or out of market standard, basically you got, issues to be addressed to the investors, okay? So that's the discount to TERP. Again, for your benefit, If you remember, when you do an IPO, you issue shares at discount to peers. Prysmian was a discount to Nexon. When you do an accelerated book building offering, de facto you have a discount to market. When you do a capital increase, you have a discount to TERP. All the time there is a discount. Okay? The negotiation of the discount to TERP is de facto a tool from risk management standpoint. A tool from risk management standpoint for the banks, because again, as I said, at the end of the subscription period, you will see whether you have a ramp or not. And as we have agreed, the lowest is the subscription price, the higher is the discount to TERP, the more is remote the possibility that the underwriting commitment materializes. New concept now. Another important misleading information that you see on papers and the discussion is when you assess, the riskiness of those transactions, the right issue. And people usually makes, calculation like, okay, this deal is gonna fly because, I'm expecting no more than 10% of ramp, because at the end of the day, I think the market will be there. This kind of narrative, this kind of wave of communication is totally groundless, because as I said, the guarantee will last for very long time. And here you take the first decision to support your own client at the announcement, and then in volume, and then here you take the second decision to support the client at the famous 40 cents. But what happened in the marketplace? We said the day one, on Monday, you start from 80, theoretically, but then the price goes up and down, up and down, up and down, like any share price in the market. And you have a floor, which is the strike price, at the famous 40. So you can write, because this is supposed to be quick. If at the end of the period here, the price in the marketplace, okay, the price at which the naked shares, ex-right, are negotiated is north of 40 cents, what do you think the market will do? The owners of the rights, if the market is above 40, what do you think will take? What do you think will happen in the marketplace? If you have a right to subscribe new shares at 40 and the market is at 60, what you do? Vai, Roberto, go for it.
They will exercise their rights?
Exactly. Okay, so we said that the rights are call option, and in order to speed up the discussion, a call option usually is a call for a period of time to exercise, at strike price. Here, and usually a rational investors exercise the call at maturity, when all the optionality of the call has been materialized. And de facto, you exercise, here at the end of the period, in these 5 days, in the last 5 days, you exercise de facto your own rights if you want. So in the last 5 days, whether the shareholders, because the price of the shares in the marketplace are at 60, and they say, I got the rights to subscribe the shares at 40, I go for it, as your friend has just told us. So de facto, if the price is north of the strike price, the subscription price, everybody will have the rationale to subscribe the shares. So basically, you don't have any ramp. But what about, like here, the price is below the strike price? What do you do with those rights? De facto, you are out of the money. Do you agree? You are out of the money. And there is no reason why you should subscribe new shares at 40 while in the marketplace are trading below 40. No rational investor would do that. So basically what I'm trying to tell you is that the right issue is a highly risk transaction because it's binary. It's not true that could be successful 80%, 70%, the risk is minimum, you know, there will be 90%. No, excluding some exception, the right issue, either it goes 100% or almost 100% or zero, because the call at the end of the process either is blood in the money or is not. Is that clear? That's why there is this big tension at the weekend, because the board wants to reduce the potential dilution of the existing shareholders in terms of governance, ownership structure, and on the other side, the underwriters wants to have as remote as possible the possibility to be on the hook. As a result, you know, there is a tension between the two parts. Is that clear so far, the mechanism of the underwriting agreement and the tension with the board and the negotiation and the way it works? Is that clear? Because now I want to make another 2 further steps and asking you a few things. Yeah, clear, perfect. Let's provoke the discussion now, because we have another 10 to 15 minutes on right issue to spend together. For 3 weeks, I said, the market has 2 sub-markets where for those 3 weeks, investors will go in and out very quickly, which is I got the possibility to have 2 rights, which allows me to subscribe a new share, or I can buy these shares already existing in the marketplace. And based on the economic convenience, I can either sell the rights, take the cash and buy a naked shares, or I sell the shares, get the money and buy rights. Or I can buy a portion of rights and basically, you know, in order to buy an additional shares. So de facto, there is a big recirculation of the rights because, you know, you buy and sell call and you buy and sell the underlying asset all the time around the economic neutrality, you know, the parity, because there is possibility on one side to make money, and on other side, you need to see how the exercise will end up with. In your opinion, given an exposure that you want to have, let's assume that you want to be long of one share of this company. What is the rational and most prudent position that you can have in the market, in your opinion? Let's assume that you're here and you want to retain the possibility to have 1 shares at the end of the process. What would you do to be on the safe side, the most prudent position, having exposure? Buy 2 rights. Bravo, Niccolo. What really means buy 2 rights? Try to think about what it means to extrapolate as much as you can this position in the marketplace. If the market buys 2 rights, the whole market, what happens? Everybody goes long of rights. Okay? So the economic neutral position that allows to have an exposure is to go long or rights as much as I can and short the shares. So in the first second of the market, that's where the market position itself. Boom, sell all the shares, get the cash and go long rights. And why this position is economic neutral? Because it provides you the exposure of one shares, but is safe, okay? Because think about for a second what could happen in the market. If you buy one share in the marketplace, we said theoretically you should pay 80 cents for it, or whatever is the price, okay? But let's assume for the benefit of the discussion that you pay the theoretical price. But if the price then goes down or up, is very different situation, because if at the end of 3 weeks the price went up, you bought at 80 or whatever is the market price, the price went up and you are an happy investor. But if for any reason the price went down, you got all this loss. The difference between the price of the naked shares versus the market price. On the contrary, you can buy, as I said, actually, as Nicolo said, I can take the same exposure by buying 2 rights. So we said one right is 20 cents, so I spend 40 cents. And then I see what happens. You know, theoretically, the market price on Monday will be 80 cents, and then it moves. If the price goes up, my cash exposure here is 40. And if I see that the trade is in the money, I spend the money, another 40, and I get de facto my shares. But if the price went down, and my option is not on the money, in the money, sorry, you know, I have the possibility to say, okay, I don't want to buy the shares any longer. I got economic exposure for it, but I didn't spend all the money for it because I spent only 40, and I stop loss at 40 cents. So de facto, the same economic exposure, 2 rights versus 1 share, can produce the same economic results when the price goes up, and we are in a good territory, but different losses in case the price goes down. And basically, the position in the trading market will be immediately to buy all the rights, be economic neutral, but with the stop loss at 40 cents. Is that clear? Is that clear? Okay, excellent. Last concept that I wanted to share with you. Let's assume that we got a ramp. And again, as I told you, right issue could be painful. If there is a ramp, it's because the market collapsed and the options of the existing shareholders and the market are not in the money, so they don't subscribe the shares, and because the guarantee kicks in, you have banks having, you know, all the shares on their lap, 250 shares at 40 cents. So it's a big risk. How these underwriters can manage this risk? As we said, as a result of the put options in the end of the board of directors, okay, we know that underwriters are long, because if someone has a put on you, you are long of the underlying asset, you are long at 250 shares at 40. How underwriters can protect themselves, how they can hedge themselves, how they can actively manage this risk exposure, in your opinion? How do you manage the delta underlined on a put? Delta means the, you know, the variation in the share price that quantify the economic risk. How do you neutralize this exposure? I know it's a tricky question, but maybe you can get there because you have done derivatives, no? Okay, someone of you says, I can buy or sell the underlying. Okay, it could be an option, but let me ask you, if, or sell a put option, okay, another options. What happens if I sell the underlying or selling a put in the marketplace? What do you think will happen in the marketplace? Who's gonna buy these shares? What I'm trying to tell you is that what could be the reaction of your own client if he's asking you here to underwrite and support the transaction in volume, and here you negotiate with them and you have agreed that you're going to support the transaction at 40 cents for 250 shares. What is going to think about you if you promise to support the transaction and then to hedge your economic exposure, you sell the shares or you sell put options in the marketplace? Do you think he's happy? What happened if the underwriters will start selling the shares? What do you think the market will think about this behavior? Do you think it's good? Would you like to have your underwriters to sell the shares in the marketplace while you're executing a capital increase? The real answer is that there is no way underwriters can protect their own economic exposure, because it's illegal. Not only is bad, but it's illegal. Not only is a bad signal, not only is a bad behavior on behalf, for your own clients. That is bad, but it's illegal, because you cannot have an assignment where you commit yourself and act economically in the marketplace against this commitment. You cannot do it. So in the underwriting agreement, there is a section where it is formally forbidden to activate any form of hedging and short in the marketplace during the execution of the transaction, because otherwise you go against your own obligation. The only thing that you could do is called sub-underwriting. Sub-underwriting is something that you can agree with your own clients, because what happens when a company is already listed and is already in the marketplace for a number of years? Everybody knows this company is covered by research. Investors used to have the shares for a number of years. As a result, it could happen that, banks on the trading floor, they know which are the shareholders that they like the stock, which are the shareholders that they want to be long on the stock, and so on and so forth. So it could happen that you can ask those shareholders, it could be Fidelity, it could be PIMCO, it could be BlackRock, Blackstone, you name it, and you say, okay, I got a reverse inquiry from those institutional investors. In exchange fee, they want to be exposed to the transaction in order to reduce the economic risk. And if the client said, I don't see any problem that you sub-underwrite a portion of your risk to those people, what you do, you were long of 250 shares, and you go to BlackRock, say, okay, how many shares you want to sub-underwrite? And BlackRock said, let's assume 50, you allocate de facto potentially these 50 shares, and your own risk from 250 goes down to 200. So rather than selling in the marketplace 50 shares to reduce the exposure from 250 to 200, you sub-underwrite this risk to those shareholders or those investors, because you know that ultimately, no matter what happens, they will be there for the transaction because they like the stock. It could happen that the market goes down those days, the option is out of the money, but they have a long view and they want to make it anyway. Sub-underwriting is the only way legally explorable that you contemplate with your own client to download the risk. And finally, the last concept. What happens if I end up with a ramp? Goldman Sachs, Morgan Stanley, Merrill Lynch, you name it, are de facto, at the end of the period, long of 250 shares in the marketplace. And the price, as we know, are below 40 because the you don't have the options is not in the money. So what happens? What do you think the banks will have to do? So you're long on 250 shares. You are not on the business to have exposure unwanted. This is a forced exposure. This is an exposure that materializes because you got a very bad risk judgment call in the first place, because you said, you know, I'm fine with the 50% discount to TERP, I'm fine with the 40 cents. The market in 3 weeks time collapsed, and guess what? You are long on these shares. So what do you do then with this exposure that are on your own books? Let me tell you, you're going to sell it because you don't want the exposure, because it sucks capital, absorb capital, and you are not in the business to have unwanted exposure. And guess what? You want to sell the shares. The market knows that you are long because the results of the capital increase are published in public domain. And what I taught you is every time you sell shares in the marketplace, you need to offer a discount. Otherwise, the market is not there. And there will be a bloody tough working session for the traders of the underwriters, because they need to sell shares, and everybody are shorting shares in the marketplace because they know that there will be extra supplies from the banks. So people in the market short shares 250 because they know that you're going to sell 250. And guess what? The price is not 40 any longer, it will be 39, 38. So every day, unless the market, you know, suddenly recovers, every day that passes by, there will be an amplification of your own loss. Your own loss will be widening, okay? So this is almost everything from a technical standpoint on the right issue. I want to spend the last 5 minutes on the, okay, here, please, I want you to read those two cases, the Unicredit and Amundi, because again, it's a good reading to, you're gonna see all the concept that I mentioned to you, that I explained to you. Here is, you know, the parity. Actually, this is another concept that I wanted to share with you. We said that the parity is, I got 2 rights, 20 cents each to subscribe a new shares at 40 at TERP. But then, and this is the parity should be 0. But as you can see, the parity as a discount that you know in the market materializes versus the parity, because there is not only the perfect alignment between the value of the 2 rights and the subscription price. De facto, you know, people are selling the naked shares, buy the rights, selling the rights, buy the naked shares, but there is not always the parity. Why, in your opinion, the reason why there is no parity, because we're short of time, is because this call option to subscribe the new shares is different from any normal options. Because in this case, In this case, de facto, you got the shares only after the settlement. So while in a normal call, you have the delivery immediately, T+1. So you exercise the call and the day after or 2 days after you got the shares. In this case, the shares are not there. The underlying asset will be issued all at the end of the process in 3 weeks time. So almost in a month. So these months of exposure where the call gives you the right, but not the physically ownership of the shares because are not physically available, this small difference creates the discount in the marketplace. Okay? On Amundi, please read how we structure the pre-allocation of the rights, because Crédit Agricole wanted to be diluted in the capital increase. Read it, and if something is not clear, you get back to me or to Gmede, okay? Now, only a few minutes on the private placement. Private placement means something private, dedicated to a very narrow number of investors, while when you do an IPO, a right issue on accelerated book building offerings, you get the whole market. Here you have only few, investors, and you can provide them opportunity to buy any underlying asset. It could be senior debt, subordinated, or even equity, all the spectrum. And what I want you to know is that the preparation of the deal is almost the same as a normal public transaction, but is more concentrated in a couple of weeks. So you do for 2 weeks the work for a couple of investors, sometimes even one only. And the case study that I wanted to tell you is that, unfortunately, we have only a few minutes, but it's a case that I suffered personally. We go back in 2008. You remember 2008 at the end of the year, shock on liquidity in the market, American on his knees, liquidity has been shrinking dramatically day in, day out, and Lehman failed, okay, went bankrupt. I don't want to debate whether it was the right thing to do or not, but that's what happened. The share price of all the banks collapsed, including Goldman Sachs. So the government wanted to restore the solvency of all the banking system, and they were saying, guys, you cannot raise capital in the marketplace, you need to take the money from the government. And for institutions that they were sound, like Morgan Stanley, like JP Morgan, like Goldman Sachs, to get the money from the government was a nightmare. This is the temple of capitalism. Nobody wanted to have the money from the government. De facto, get the money from the government means to be nationalized. It was like a shock. A lot of negotiation, but when there is a crisis, you need to do whatever the government says because you are in a regulated business. So because of the application of the TARP law, the government recapitalized indistinctively all the major banks in US. JP Morgan got 20 billion from the government. Goldman Sachs got 10 billion from the government. We were on our knees because internally, we lived this experience like a shock. We are now owned by the government, which means we are not entrepreneur any longer, we are not banker any longer, compensation will be different, blah, 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 blah. So the most important objective for us was we need to repay the government as soon as possible. But it was still very complicated to raise money in the capital market. Okay, because the market was still very suffering, was not functioning well. So we thought we need to have an investor that is so good, so credible, whose reputation is so high that if he agrees to invest, people will say, Goldman is a good company. The market is in crisis, but Goldman is a good company. We trust Goldman and we can make, money at work with them, and the confidence in the marketplace will be even further restored. What happened was we negotiated 5 billion of a perpetuity with the Berkshire, okay, Warren Buffett, and with a 10% bond coupon recallable before maturity at 110%. And in addition, an additional 5 billion equivalent of warrants for new shares at 150. So the market was below 100. As soon as we announced this trade, wow, they got 5 billion. They also have a warrant to exercise another 5 billion. And on the back of it, the market started rallying, and we issue shares in a capital increase executed in an accelerated fashion at 123. So we raised 5 billion plus the green shoe, so 5.8 approximately, plus 5 billion of preferred shares, the famous 10 billion. And guess what? The market was back on its shape, back on its feet, and we were so happy, back with our destiny in our hands, because we had 10 billion raised in the market by private players, and we went back to the government in January of 2009, and we managed through the negotiation to repay all the capital injection, okay, to repay in full. So we were happy, back independent once again, and guess what? Everybody was fine. We were chest beating, you know, the mood was over the moon. But then after the euphoria, we said, hey guys, but every year we pay 10% of 5 billion, so 500 million euro. So in 2010, we start saying, well, you know, we need to, now that we are on our feet and we are solid and the market is start functioning again, the crisis is over, we recapitalize, we need to repay Buffett. It's too expensive, 10%. We need to pay him 500 million euro per year. But then we realize, okay, but if we want to call him back, we need to pay 110%, so another 500 million euro. So de facto, in 1 year time, Berkshire, in order to repay the preferred shares, earn 1 billion out of 5 billion, 20% return in 1 year. Not bad at all. And when we realized that also he had in his hands 5 billion warrants to buy shares at 115, while we were trading at 135, more or less, that was hugely in the money, highly dilutive. We said we need to buy back also the warrants, and to make the long story short, another 500 billion check has been, you know, paid. So because the relationship with Warren Buffett was excellent. So in just a bit more than 1 year, Berkshire, Warren Buffett made $1.5 billion profit on the position. So basically, 1.5 out of 5 billion was 25%. Actually, 30%. Then we start saying, who's the smartest guy in the room, us or Warren Buffett? What I wanted to tell you is that in finance, the good and the bad deal has been determined or considered only at the time when the decision has been taken. Of course, when we were at the beginning of 2009, we want to repay the government, that transaction looked perfect, and actually was perfect, because it allowed us to raise the capital in 2008 and be totally free. But only 1 year after, when the market changed, it turned to be a very expensive deal, because we paid an internal rate of return to Warren Buffett almost 30%. So in other words, this case explains different things. Private placement could be the solution where the market is shut. Private placement can be the backbone in order to support a capital increase that look on paper impossible to execute because of the market dysfunctionality. But finally, these instruments are always very expensive. So I will stop here. Tomorrow we're going to talk the last piece of the equity market, which is convertible and contingent capital. And, you know, I share with you a lot of technicality today. Think about it. If there are comments or questions, tomorrow morning we will, or the day after, we will address it. Okay? Unless you have questions, immediate questions, I would close here the session, and we'll see for the last equity capital market session next time around. Thank you very much, everybody, and have a nice day. Thank you.